So what yield are you getting when you're lending to these kind of small, medium companies from 3 to 30 million? How have you guys done over the last 10 years? Because that's what people want to know. That's pretty impressive. There's a lot of funds that come and go in the space, and it's not that easy to generate that much income. Yeah, but Jason, someone's listening out there and they're saying, oh my God, these guys own oil and gas royalties. This is going to blow up. Oil and gas is going to go to zero. They're going to stop producing. The royalty is going to be worth zero. Hey guys, welcome. Today I have a very special guest with me, Jason Brooks. He's president, he's founder of Invico Capital. They manage $2.5 billion. And today we're talking about one of their flagship funds, the Invico Diversified Income Fund. It's a big one. It's been very successful. It's got a phenomenal track record. I'm glad that you came to Winnipeg. Thank you for being here.
Thank you, Rob. It's a pleasure to be here at Canaccord with you.
All right, so 10 years. You guys have a 10-year track record. That must be exciting.
Yeah, and it's very fresh. So we actually will have our 10-year numbers out here later this month in October. But yeah, the inception date was 10 years ago at the end of September. So we're very proud of being able to achieve that obviously in alternative markets. A lot of products haven't been around that long. So we have a very seasoned team and a seasoned return.
Okay, let's get right into the returns. How have you guys done over the last 10 years? Because that's what people want to know.
Sure. On the Class F unit that you use here at Canaccord, we've been able to do better than 11% annualized since inception. So that's a very strong compound return. We've never had a negative year, and that return has varied anywhere from a low of about 7% to a high in 2022 actually of 17%. So
7 to 17 has been the range. The average is right around 11%. Looks like there's a whole bunch of awards that you guys have won as well. 500 million roughly in this fund, 10-year track record. Congrats on all that. That's pretty impressive. There's a lot of funds that come and go in the space, and it's not that easy to generate that much income.
Yeah, and it's the longevity return, as you know, in this business. That's the key thing, not having disruptive years where you have the big drawdown. This year we did win from Wealth Professional the Alternative Solution Provider of the Year. So that's an award category with all alternatives in it. I believe there was some 13, 14 different products in there. So we are proud of that one as well. And my business partner, Allison Taylor, also the same award, won a CEO of the Year for Invico Capital. So
CEO of the Year, and she just completed her 63rd marathon.
That's right.
How many have you completed?
I've done 2 halves, Rob. Thanks for asking.
All right, 2 halves. That's almost a full. Congrats for that too. Yes, Allison, as CEO, and yourself, you guys founded the firm, I guess, together roughly 10 years ago, something like that, or more than 10 years
Well,
ago?
Invico's been around since 2005. This fund's been around for 10 years. So obviously, yeah, we've been at the controls for a little bit longer than the fund's been around. But obviously, in the early days, we were building assets, and we've had some now since we've had some of the track record that we've had with the Diversified Income Fund. The firm's been growing substantially.
Okay, so I want the viewers to understand, how do you possibly generate 11% income in lending? How do you do it? Who are you lending to that you're getting like 11% after you guys are taking your cut, after you're paying yourself and everyone else?
Sure. No, I mean, the strategies are twofold. We do private credit, so private lending. We're focused in the small and mid-market. And the reason we're able to get a little better yields is that we're really focused on areas that are not well served by traditional capital providers. So a lot of times, we have a very concentrated banking system in Canada. Yeah. And they do a good job of very repetitive tasks, and they work well with bigger companies. But when you're looking at smaller private companies, companies that might be needing anywhere from $3-4 million of capital up to maybe $20-30 million of capital, there's an area there that's relatively underserved. And without that competitive tension, we've been able to get that type of double-digit return.
So banks used to be in that space a lot more. Mm-hmm. And why are they not there anymore?
I think they're still there. I just think there's a lot of breadth of industry in Western Canada. Some of those industries, if you're in energy or oil field services or different areas,
it's taboo.
Those are areas that aren't necessarily, banks are not growing credit to that space.
Yeah.
So there is room in those spaces. You have to be diligent, and you have to have the technical teams that we have and the ability to sometimes move quicker than the banks, which is another reason we often get a lot of deals, is that we run a relatively fast process for companies that need capital, and we can close a deal in less than 30 days. And I mean, everybody knows, banks have a sequential process, and they don't move as quick. So a lot of times companies don't have the luxury of 4, 5, 6 months to close a transaction.
Yeah, there's a band in the 70s. I forget who sang it, but they would say, once bitten, twice shy, baby. I think it was like Quiet Riot, maybe, or I don't know. Do you know?
Well, you can put the link up in your video.
So they were once bitten. You know, they said they got hurt by oil however many years ago. Now they're saying, I don't care what your cash flow is. I don't care what your free cash flow is, how strong your balance sheet is. We're not lending to that space. And you guys swoop in.
Yeah, like Twisted Sinister. We're not going to take that anymore.
Yeah, we're not going to take it anymore. I like it. So you guys are lending about less than half the portfolio into the energy space. Is that right?
That's correct. About 45%.
Okay, 45% in the energy space. And then the rest is, tell me about the rest of the portfolio. So the energy space lending, I get that. You were getting to the second point and I interrupted.
Yeah, so there's two prime drivers of income in the portfolio, and that's what we're using to pay our unit holder distributions. Obviously, on private credit, we get paid interest on a monthly basis. We distribute that out. And in our energy business, what we actually own, we're not an operator of assets. We actually hold royalties and mineral rights. So within the portfolio, there is a diversified amount of wells that are producing oil and gas. They stretch from northern Alberta right down into Colorado. So we don't have anything in Manitoba, but we do in Saskatchewan. That being said, there's over 2,500 wells in the portfolio now. And what we own is the actual minerals and the actual reserves in the ground. So third parties produce them. So it would be like analogy, you know, lots of real estate around us here in downtown Winnipeg. It's like we own a floor within a building. Other people operate the building. We get our share of the rent from that. But what it really is just part of the reserves in the ground. So these are mineral rights. It's a business that's been around as long as, you know, oil and gas has been around. It's not well distributed in traditional investments because it's somewhat esoteric. But what it gives us, Rob, is the ability to work alongside big producers who are extracting those reserves and we're selling the oil and gas barrels. Gives us a diversified income stream. And there's three real important things with that business. Low operating costs of $13 per barrel. We don't use any debt in the business or in the fund of a material nature. In fact, our debt's less than 5% of the total assets. And we also do some hedging to try and smooth the cash flows. So that's those are principles that we live by in the business. And, you don't get to 10 years by, being, aggressive. So we have a strict criteria that we deploy, and that is the same types of cash flows that we are able then to those types of cash flows we're able to distribute out on a monthly basis to our unit holders.
Yeah, but Jason, someone's listening out there and they're saying, "Oh my God, these guys own oil and gas royalties. This is going to blow up. Oil and gas is going to go to zero. They're going to stop producing. The royalty is going to be worth zero." How do you protect against that risk?
Well, we're in an energy transition, but I think the reality is hydrocarbons will be with us for decades ahead. So the reality is, if you look at the ability to displace hydrocarbons, it will happen gradually. It will happen over time. But all the other alternatives today are relatively more expensive.
Okay. So you're bullish on energy. I get that. But what about like the actual real risk? How have you measured it? What does price of either WCS have to go to for you guys to stop producing?
Yeah, so we're a light oil producer and we're a gas producer. So overall, with $13 per barrel operating cost, yes, we do pay. There are government royalties, but we're good down to $40, $45. Again, over 10 years, we've seen a combination of negative oil prices over the pandemic.
I remember.
And we've seen back in 2014, we saw a real decline in price back then to just under $40. So we've lived those scenarios. And again, hedging, low operating costs, and no debt. Those are the things that you don't get when you participate in the public oil and gas market.
Right.
You get some volatility and that obviously shows up out there. So we're just taking the income from all those 2,500 wellheads, very low operating costs, and we pay that out on a monthly basis.
And that's roughly what percent of the fund itself?
It's about 45%. Right?
45%.
Yeah.
Direct ownership.
And it's always correct. So that's real property that we own in the fund. We're actually on title to those reserves. And so it's registered, real property. And that allows us the right to continue to participate in any ongoing drilling. And that's what's happening. I mean, we're building an LNG pipeline to the East Coast. We've got additional oil and gas pipeline capacity now. So the business is actually growing, and we're seeing a lot of additional drilling. And that's very organic growth for the fund. That's very economic. Generally, wells pay out in 2 to 3 years or less.
Those are mostly in Alberta or Saskatchewan?
Most of our assets are in Alberta, North Dakota, Wyoming, and Colorado.
Okay.
Split fairly evenly amongst those jurisdictions.
How long ago did you acquire those assets, and what did you pay for them?
We started in the business in 2014, at the end of 2014. Over time, the allocation to these assets in the fund right now, we have about just over $200 million of these assets in. The cost varies, of course, depending when you bought it. When we were in the pandemic, we saw real distress in the market, a lot of low oil pricing causing a lot of challenges. So we did lean in at that time. And I've been in a cyclical business, and the times to add assets are always in those distressed markets.
Tough to do though, eh?
It's tough to do, but we had again, we're disciplined. We don't use debt. If we had to use debt to buy assets at that time, what would have happened.
Tough. Yeah.
It wouldn't have happened.
Yeah. I always say, and anyone who's watched me on this channel knows that we're not smarter than everyone else on it. We're just more disciplined, right? Because if you make your rules ahead of time and you go, when this much correction happens, we will buy. When we get 2 or 3 standard deviations away from the norm, that's a trigger for us to buy. When we get 10, 20, 30, we buy. That's easy to say. Most people would agree to that. The problem is when it actually happens.
Yep.
Do you have the gusto to actually follow through on your plan? I'm not smarter than everyone else. I'm just more disciplined. And we did it buying equities in the past and selling quality assets, buying assets that have been decimated, and you guys are doing it as well in your fund. So congrats on that. Let's talk about the other portfolio, the rest of the portfolio. So we talked about lending strategies, right? That was the first part. Correct. You talked about, and that was roughly half the portfolio, I think, or just
Correct.
under
the
half.
Target's it's about half, just over half.
Just over half, and then I guess the rest is this energy play.
Yeah.
And there's a few other residual stuff out there as well in the fund.
A little bit.
Okay.
Yeah. So there's a couple different sources of income when you're lending. There's your typical interest income. So everybody pays us an interest rate. That is anywhere from 10% up to kind of 13, 14%.
Has it moved lately quite a bit?
We haven't moved up. What we have done is incorporated variable rates, which are based on a spread off of Bank of Canada.
Right.
So as Bank of Canada's moved up, some of our loans have moved up. But, for us, it's about credit quality. It's hard to go chase loans at 18, 19, 20%. That's a difficult, to find real good quality companies because they're going to have better options. And we don't want to lend to the guys that have no choice. We want to lend to quality companies that are prepared to pay a little bit more than the banks, but not something like double. The market today, because interest rates have gone up substantially, as obviously it's impacted everything. So the yields have gone up overall in the fund a little bit. But what's also been interesting is that because our spreads are traditionally low right now versus the bank, because bank rates are actually high double or high single digits, I should say. So it's giving us the ability to have a broader universe of people that are interested in borrowing from us.
Right. So basically it allows you for the same rate you used to lend just to take less risk.
Yeah. So it's helping us pick better credit quality opportunities. Yeah. And our yields have gone up a little bit, but it's been because we're growing. It's been a great way for us to capture quality.
Talk to me about the default experience in those loans and what
Sure.
It's been like and what that's looked like.
Yeah. So over 10 years, we've had $15 million of principal that we have had to write off. Currently in the portfolio, we have about, it's less than 3% that we would consider in default. And we measure default very strict criteria. If there's a company that isn't able to make their interest payments within the prescribed terms in the agreement, we put them into an in arrears bucket, and that shows up as a default. And then obviously if there's a protracted non-payment, then there would be, we would be considering enforcing security. But that component of the portfolio is again less than 3%, Rob. So we are in a good performing environment. We haven't seen an increase in default rates, although as you point out, interest rates have gone up. We haven't, doubled our rates or anything like that.
Right.
So the clients that we work with, we're in an environment where it is inflationary out there as well. So they're getting higher prices for what they're doing.
Yeah.
And that's been able to offset some of the increases, obviously, in their cost of capital.
Those are the winners that you want to deal with, the ones that are able to capture some of that transmission of inflation onto the consumer, if they're able to capture as much of that as possible.
Exactly. And that's been in a lot of the traditional businesses that we deal in. Talking about energy earlier, there's a lot of associated companies that work in the energy business, and they're enjoying some better pricing.
Yeah, you want to capture that inflation, or you want to drive NOI.
You need that, yeah.
Okay, so less than 3% default. What is that historically relative to the funds? Is that average? Is that below average? Is that above average?
Yeah, the default rate's been anywhere from kind of 1 to 2% up to, maybe 5%.
Okay.
Would be in the peak. And the thing what you have to remember, to get to 10 years, you have to be able to handle distress and default in your portfolio.
Well, you have to, because it's going to happen, right?
It's going to happen.
You can't lend at 12% and never have default.
If you have somebody on this YouTube channel and they tell you they've never had a default and they've never had a loan go bad, they've either not been around very long, or they're beyond lucky, or maybe they're not being truthful. So yes, we do have defaults. We have to deal with it. And we have an internal team to handle that have, backgrounds in insolvency, backgrounds at myself, backgrounds at the Big Four accounting firms, dealing with these processes and working through with that. We don't want to upset the apple cart. We want them to perform. But in the event that we need to take the, enforce our security, sometimes that has to happen.
Whatever happened to the apple cart? Is it?
I don't know. I think
I
passed one coming in
from time
today.
to time? Is it people shaking it or people kicking it over? Is that a thing that happens? The proverbial apple cart is usually how it's described.
That's right.
Okay, so I want to ask you about these oil assets.
Mm-hmm.
So how much delta is there in there? How much leverage is there? If oil goes to 100 or 110 or 120, how much of that do you guys get? Is most of that hedged out?
We hedge up to 40 to 50% would be the top. So no, the answer would be the way we manage this fund, Rob, on the energy side is that we pay out a base distribution to unit holders. This year, that's been set at 9%. That varies off of Bank of Canada because we have to stay competitive out there for investors. So there's a spread off of Bank of Canada. The floor is 6%, the ceiling's at 9%. We're at the ceiling now, so we're paying out a base distribution of 9%. Because we're enjoying income above that level, what we also do is on a quarterly basis, we'll look back and determine whether the cash flows that we received support paying out additional distributions to clients.
Some sort of top up.
It's a top up. It's an additional distribution. And that's been paid all 4 quarters in 2022. We paid the second quarter here, and then we're coming up on the third. We'll look back and determine whether we can pay another additional distribution. It's looking good because, as you point out, we've enjoyed pretty healthy commodity pricing and we've had increasing yields on the private credit side of the portfolio. So by being conservative on setting the base distribution at a sustainable level, we've never missed a monthly distribution over 10 years. And when we do have the environments like we're in today, we pay out those additional distributions and the investors can decide whether they would wish to receive it in cash and go diversify further, or if they want to get the effect of compounding, they can drip the units.
More units.
And obviously get that appreciation.
Okay, so you're paying 2.25% per quarter, roughly 0.75% per month. You do pay monthly.
We pay monthly.
So that's every month an F-class holder is getting 0.75%, and every 3 months they hope to get a top up. The top up's been 1.5 to 2%.
The top up in 2022 was actually 3%.
3%.
Yeah.
Wow, per month.
Sorry, no, that was for the whole year.
For the whole year.
Yeah,
okay.
It was just under 3%.
But the total return in 2022.
So the total return included some accretion on the net asset value.
Okay, the NAV moved.
The NAV moved up. Yeah. So when you're in the Invico Diversified Income Fund, your return experience is going to be mostly cash pay.
Yeah, you're getting that nice thick cash flow.
You're getting 9%. If we're achieving above that, then you're getting additional distributions. And there may still be some accretion in NAV as we had last year, but we've been able to perform at, better than a double-digit rate for some time now.
Yeah, so 2016, 9%, 2016, 9%, 2017, 9%, 2018, 10%, 2019, 9%, 2020. So it's been extremely consistent. The 10-year number, the 3 and the 5-year number are all quite good. Let me ask you this. If we're sitting here in a year, you and I, and you're sitting at this table because you love Winnipeg so much, and you came back and you chatted with me again, and I go, how come you guys had to cut the distribution? How come you guys had a terrible year? What happened?
Well, we haven't had to do that in 10 years. So if I'm back in Winnipeg next year and we've cut the distribution, maybe the Jets have won the Stanley Cup, though, because that could be another very unlikely scenario. But nonetheless, let's go through that because our unpacked oil and gas, we went through that. So that would mean we'd have another route down in the markets, maybe below 40 barrels. But that price of less than 40 barrels would have to be sustained over the year.
Because you have a hedge.
We have the hedge, so it would have to outlive the hedges, which we actually put in hedges for 2 years.
2 years. So it'd have to be
up to 2 years.
For about
so
half
let's
the
say,
portfolio.
so you'd have to really be in that market for a protracted period of time. And then you have to have some type of credit event in the portfolio where we had a substantial default or something like that. But being a majority first position lender, focusing on the security, we usually have assets that we can secure against. And if really were in a bad shape, then those could be liquidated.
Okay,
to
so
recover
when you take
capital.
security, when you lend someone 3 or 5 or 8 million bucks, a business that has cash flow, that's got assets, you would normally take first security, always take first security?
We take first security in anything other than real estate. So in real estate, to get the yields where we're at, we will do a second position.
From what
but
percent?
the loan to value
Yeah.
has to be under 80%.
Okay.
Right now, any seconds in the portfolio are actually around, they're quite a bit less. They're around 70, 72%.
Okay. So if you take a second in real estate, you're going in that 65 to 80 range if you need to, or 60 to 80 range.
Yep, but we're not doing development. We're in Western Canada-based multifamily residential lending. So these are cash pay rents from workforce housing. They're using our money to go in and refurbish and improve the properties, which generally allows them to move rents up and again refinance us out. So it's a strategy that we've had in place for a long time, and it's been working very well. But the rest of the portfolio, we really do focus on first position because, as you point out, we're here because there will be rainy days, and you still want a portfolio that can survive that.
Yeah.
And you want the inflation hedge. And the inflation today, it's been really the toughest headwinds in the market. Interest rates and inflation have led equity markets to really have some difficulties over the last couple of years, and bond markets. So in that market, what you want your alternatives to do, we've been doing. We've been generating good level of steady income, and we've had some improvements
the
in
inflation.
that. So we've offset it and given unit holders, I guess, a breath away from the public markets.
Well, I'm bullish in Western Canadian real estate, multifamily real estate. Those who know me, those who follow the channel know that. I believe this is a seriously underpriced market. When you compare, eventually people in Toronto and Vancouver and Montreal and Waterloo are going to be like, I can live in Winnipeg for X. And I do believe that long term this market will appreciate value, and I believe it's an incredibly safe asset class to be lending to. If you're lending multifamily real estate in Winnipeg, even if you go to 65, 70, 80, I do think that that's a safe.
Yeah, we do have actually some lending in Manitoba and Winnipeg area. It is. I agree with you. The replacement cost, all this housing that's out there is much, much higher than than what they can. Obviously they're getting reasonable rents in these markets. It's affordable. The prairies are affordable in general, and I think you're gonna see migration.
Plus, who wouldn't want to live here? All right, Jason, I want to thank you for coming today to Winnipeg. Talk about the fund generating 10+% returns, 9+% cash flow paid monthly for F-class unit holders. You just don't see that in the fixed income space. So distribution of 9%, 0.75% paid monthly. How much of that is classified as income versus dividend or return of capital?
So we have some tax advantage from some of the recycling we can do in the energy business, and our return of capital is about 40%, and then the balance being income.
Yeah.
So that does give you some tax efficiencies.
That's fantastic. It's way better than most of the private debt funds out there, which are usually 100%.
Pure private credit. If it's not income on your tax return, you should be concerned.
Exactly. All right. Well, thank you so much, Jason. I appreciate you taking the time.
Thank you, Rob. It's been a great day here.
Thanks, guys. We'll see you in the next video.